Welcome to Frost and Sullivan's Growth Podcast. In each episode, we take a deeper look at transformative shifts shaping global ecosystems, from industry megatrends and technology innovation to evolving customer expectations. Today, we're exploring decarbonization, digitalization, and the future of oil and gas growth, unpacking where the next wave of opportunity is unfolding and what it means for future-ready businesses. As we approach 2026, oil and gas companies are navigating unprecedented pressures. Decarbonization mandates are tightening, price volatility persists, and technological disruption is accelerating. Why does this moment matter so much?
It matters because these pressures are converging rather than unfolding sequentially. Decarbonization is no longer a parallel initiative, it's shaping core operational decisions. Companies that still rely on siloed models are struggling, while those integrating low-carbon strategies with digital technologies are unlocking efficiency gains, emissions reductions, and new business models simultaneously.
At the same time, companies are expected to maintain short-term energy reliability. How are leading organizations balancing reliability with long-term net zero commitments?
The leaders are taking a pragmatic approach. They're focusing on targeted investments that deliver measurable impact today while supporting longer-term decarbonization goals. Partnerships, service-based models, and digital tools are helping them reduce capital risk and maintain operational resilience without slowing progress.
Let's look at the forces driving this transformation. Industry convergence is one of the most visible shifts. Why is collaboration accelerating now?
Decarbonization at scale requires capabilities that no single organization can deliver alone. Oil and gas companies are partnering with airlines, utilities, and industrial players to scale solutions like sustainable aviation fuel and integrated low-carbon hubs. These collaborations share infrastructure, spread risk, and significantly shorten deployment timelines.
Technology is another major catalyst. Which technologies are redefining leadership in the sector?
Carbon capture remains essential for addressing hard-to-abate emissions, while hydrogen is opening new, low-carbon pathways. At the same time, AI-driven asset optimization is transforming operations, improving efficiency, reducing emissions, and enabling predictive decision-making across the energy value chain.
Beyond technology, we're also seeing business model innovation. What's changing there?
We're moving away from asset-heavy ownership towards service-based and platform models. Carbon capture as a service, integrated low-carbon fuel hubs, and ecosystem platforms are reshaping how value is delivered, making decarbonization more accessible, scalable, and commercially viable.
Which companies stand out for translating these strategies into real-world execution?
Carbon Clean is a strong example, with modular Cyclone CC technology that reduces both capital and operating costs, paired with carbon capture as a service offerings. SLB is leading in subsurface monitoring and MRV, using advanced seismic, well integrity, and fiber optic technologies to enable safe and verifiable CO2 storage. Climeworks is advancing direct air capture, operating the world's first commercial DAC facility and targeting megaton-scale capture by 2030.
What lessons can other organizations take from these leaders?
The key lesson is a focus on scalability and execution. These companies design solutions to be modular, digitally enabled, and repeatable, while relying on partnerships to accelerate deployment rather than trying to build everything in-house.
Turning to investment priorities, carbon capture as a service is gaining traction. What's driving this shift?
Traditional CCUS projects face high upfront costs and long-term storage liabilities. CCUS as a service shifts carbon capture into a managed service model with pay-per-ton pricing. This reduces financial risk, simplifies execution, and expands access for smaller and new emitters, accelerating adoption across the value chain.
Monitoring and digitalization are also critical as CCUS scales. What's driving investment in this area?
As CCUS deployments grow, continuous and real-time monitoring becomes essential. AI analytics, digital twins, remote sensing, and fiber optic monitoring provide auditable data, support regulatory compliance, and improve long-term confidence in CO2 storage performance.
Direct air capture is another emerging opportunity. What's changed to make it more viable?
Early DAC plants were costly and bespoke. Today, modular and standardized designs enable faster, repeatable deployment. Policy incentives, carbon removal credits, public funding, and shared CO2 transport and storage infrastructure are improving economics and accelerating commercialization.
As we look toward 2026, what will define success for oil and gas companies navigating this transition?
Success will come from embedding low carbon strategies into core operations. Companies that integrate CCUS, digital first project design, and data driven emissions intelligence will be better positioned to manage risk, meet regulatory expectations, and capture new growth opportunities.
That's a clear and practical outlook, focused on integration, execution, and scale as the energy ecosystem continues to evolve. Thanks for joining us on Frost & Sullivan's Growth Podcast. For access to our research, competitive benchmarking, and best practice frameworks, head over to frost.com or email hello@frost.com. We'll be back soon with more to help you stay clear-headed and growth ready.